Okay, my name is Mr. Kibona, a professional and registered tax consultant in practice. Today, I want to have a discussion with you on my channel so that we can grasp some knowledge before get starting in the examination. For those who are preparing for the diploma exam, in any case, whether it's a certificate or the diploma itself, please, you should not hesitate, get started. Actually, the exam is very simple, and you need to have a key area where to concentrate, especially during this final touch. And I'm praying God so that you concentrate on it and you make sure avoid using much time in social media, especially in WhatsApp groups, which is not benefit to you and even to the profession itself. If you listen almost 10 video from my presentation, starting with the previous one, I'm sure you are going to pass the exam as at higher mark. So in case of anything, you can call me using this number in case of anything, including players, professional issues and that. So don't hesitate to call me during this preparation of examination. So I've decided to communicate with you through this channel because I'm sure some people are not having enough time to attend classes or to concentrate on a particular fact, or you have been very busy in the preparation of financial statements, which is to be audited, and there are several corrections from the directive of Supreme Auditor. So people have been busy, and perhaps you don't have time even to listen carefully from the teachers or to even read. So through this discussion and this video, I will make a summary so that we make a point of discussion. First of all, I will make a simple how the exam is. There are two papers in examination. We have paper 1. In the examination, there is paper 1. This is an open paper. A closed paper. We call a closed exam. So this closed exam consists question 1, question 2, question 3, question 4. The question 1 always is allocated 40 marks, and the rest is 20. So we have distribution of marks somewhere. So this is 40 marks. This is 20 mark. This is 20, and this is 20. So that to make a sum of 100%. This is a closed paper. So you are not allowed to enter with any material. So far, what is in question number 1? This one measures several standards. It measures the ability of the student to prepare financial statements. The set of financial statements that includes the statement of financial position, the statement of performance, the statement of cash flow, key issue relating to PP schedules, key issue relating to audit queries, case study, collections, and others. So it is a practical question as to X. Actually, I thank God that NBA has designed this question. It's a very good question that it is very participative. If you are working on fine account, mostly no problem. But remember, standards like Ipsas number 1, Ipsas number 2, Ipsas number 3, Ipsas number 19, Ipsas number 16, and Ipsas number 17 must have been covered fully with the practice so that you apply them in question number 1. The rest of these questions, actually, they are also with other standards. So this is paper 1, a closed paper, and you need to pass the exam. And each paper is assessed separately. So once you see paper 2 again, paper 2 also, it is an open paper. So just change here. Paper 2, it is open paper. Open book, we call open book. So you enter with your materials, your books, even the laptops, except the network connections are not allowed. So this paper also had 4 marks, 4 questions, and question 1 is also 40%, and the rest of the 3 questions each consist of 20 marks. In total, it is 100. So this paper is open book. During the exam, you enter with books, materials, and others. This paper also, it is extensive. It needs knowledge of thorough discussion on how to respond from the examiner on different key issues. Once you see these 2 papers are the same, but the paper 2 needs details discussion on particular response on any item you have been asked by the examiner. So remember, because you enter with books, we are expecting that you produce a thorough answer and very details as compared to paper 1. So this is how it works. So don't worry. I'm sure paper 1 and paper 2, you are going to cover them separately with different days. For example, if you do a paper on Monday, on paper 1, next, perhaps on Thursday or Wednesday, you do for paper 2. So what I can now tell you, don't hesitate anything. Don't hesitate the exam. Try to concentrate discussing your fellow. Avoid having your friends who are threatening. So this is, you should be positive toward the examination. Remember to get started. From my discussion today, I will explain some key examples of examination. For example, this is an example of paper 1, a closed book. It's an example. So I will try to make you understand and see how these problems are there. So I will pick problems from introduction, problem from conceptual framework, problem from a basic understanding of Ipsas, problem, a normal problem that perhaps you can face during preparation of financial statements and key issues. So this exam was done on the 13th July 2016. It is a closed paper. It is a paper 1. So how to get started from this exam? So I will concentrate on how this question appears and how to respond it professionally so that you become aware on it. Now, question number 1 of this paper. Question number 1 of this paper. This is a question number 1 of paper 1, which was done on 13th July 2016. What was the response to the students and even for the discussion to make sense? As you can see on board, he said, you are the chief accountant of the Ministry of Transport. You are the chief accountant of Ministry of Transport. Your ministry got an qualified audit opinion. Now see this word here. Unqualified audit opinion. So the examiner is trying to tell us what is an unqualified audit opinion so far. The permanent secretary in the ministry congratulates you that you have an unqualified audit opinion for the year ending 30 June 2015. And this has been to the most cases, even government agents, like for example, TRA, once they have been issued an unqualified audit opinion, they become happy and celebrate. But within the team of accountants and even auditors in the ministry, some people do not understand the meaning of unqualified audit opinion. But they keep on celebrating that, okay, we are having an unqualified audit opinion. Now, what is it? Now, the permanent secretary in the ministry congratulates you as a chief accountant. Okay. Now, what he's saying, the opinion paragraph read as follows. Now, this is a phrase from an external auditor. He's saying, in my opinion, the financial statement present fairly, in all material respect, the financial position of the Ministry of Transport at 30 June 2015, and its financial performance and its cash flow for the year ending in accordance with international public sector accounting standard. Now, this phrase is where an examiner is concentrating, and it has been in most cases during our preparation of financial statements and our audit response. We are waiting to be issued with an unqualified audit opinion, and this paragraph has been inserted in audit report. Now, the permanent secretary in your ministry is not clear of this opinion paragraph and ask you to clarify for it. So the permanent secretary is saying, now, what does this mean? And why are you celebrating from this? Now, the examiner is now requiring you to, as a professional accountant and a chief accountant, and also somebody who has gone through Ipsas diploma certificate with NBA. So you have to prepare a presentation to the permanent secretary explaining how a fair presentation of financial statement can be achieved so that we continue celebrating it. Now, it is from here you have to explain, and there is an allocation of 8 marks from this problem. So this is an example. This problem is not so much a very new problem to us, but it has been practiced. That's why I can congratulate BA to have these problems which are practiced. First of all, we should discuss what are the types of audit reports so far. I will just start here, a very simple and clear. Don't concentrate on picking how I'm making this a solution, but I want first of all to make this question to be a basis of discussion of other questions that may arise. But even the profession itself, we should be very much aware on what to do when similar cases of this question may arise during examination. So far, let us explain the term, or let us discuss briefly types of audit report and the term unqualified opinion. Actually, an auditor, for this matter, I will talk an auditor, but I refer the CAG, Control and Audit General, who is responsible to audit financial statements for the government. What is so far a key issue? So the auditor is auditing. Now, who is an auditor? Is an independent person who examines financial statements using Ipsas compliance prepared by the accountant and therefore issue opinion on whether those statements present true and fair view. So an auditor is an independent. An independent unit. For this, when I say now, it's an independent unit of the government which examine financial statement prepared by accountant. Now, at this case, we are saying accountant general, or where the main case may be. Now, using what? Prepared by accountant general using Ipsas. So remember these words. The financial statement might have been prepared by using the appropriate reporting framework. Currently, we are using Ipsas. For example, if the government says that use Ipsas, and then you have applied FRS to it, then that is not fairly presented. So using Ipsas, so intermediate unit which examine financial statement, prepare the accountant general using Ipsas, and issue audit opinion as to whether they present true and fair. True and fair view. So I will make a discussion here. Now the auditor will audit financial statements, and the financial statements, they present information, transaction events presented in a period of 12 months. Now I will make it simple. So a supreme auditor is examining financial statements, which includes events for a period of 12 months during the year. So now these events, transactions, and others, they are huge events within 12 months. So an auditor will do this work by sampling. Now, audit sampling. Audit sampling. Now, in an audit sample, so it's just a sample. When I say sample, it's a test reagent. Somewhere you have a sample. You have a sample here. In a laboratory, you put sample. You can't test the whole tank of the chemicals. So you put a sample. So you should have a reagent to test. A reagent, those who have gone to the laboratory, they know about the reagent. So the reagent is testing the sample. This is the sample. Now, the reagent is looking for the reaction. Here, the reaction. So an auditor will prepare audit program as per ISA 500 to request for some few sample. And an auditor is looking misstatement in this reagent sample. So reaction, misstatement. Misstatement. This misstatement may be because of error or maybe intentional. Now this to do with ISA 240. So the auditor is looking for the misstatement. So the auditor will be sampling and looking for misstatement. Now, everything must have its own standard. For example, sampling, there is a standard which guide how to get a sample and method of sampling. Now, what happened? Once an auditor has issued audit query based on this sample, an accountant must respond from audit queries and make a discussion on audit findings before the auditor to issue opinion. So the auditor is sampling to get audit evidence. Remember, why sampling? We need audit evidence. Audit evidence in Ipsas 500. This audit evidence will support audit opinion. Once you issue opinion, you need to have audit evidence. And that's why once you issue a sample, once you sample the financial statements, for example, watching, and you see something misstated somewhere, you have to write an audit opinion to the management so that they respond before you issue an opinion. Now, during discussion with the management, two things may arise. That's where I want to make it clear. Two things may arise during the discussion. You may agree. So there are two factors on audit opinion. I want now to discuss how to formulate audit opinion. The audit opinion. How to get started on this. So there are two factors. Number one, disagreement with management. Disagreement with management. Or number two, maybe there is a limitation of scope. The limitation of scope. The auditor did not have enough time to audit financial statements, or technically it was impossible to have some technical issues to extract evidence. That is the first step. So if you disagree with the management, only the so-called management respond, because an auditor must issue an audit query, which is a letter from the auditor going to the management, and the management must respond. From all these two, the auditor may disagree with the management on response, or the auditor may have a limitation of scope to audit certain item in financial statements. Now, what are the key issues? There are two key issues. Key issues. Only subject matter. Number A here, the key issues. Maybe the issue which you are in disagreement may affect the whole financial statement. Let me put this one very important. If you are discussing a subject matter which affect the whole financial statements, the issue affect the whole financial statements. So it is a material and affect the whole financial statements. In auditing, we are saying this issue is pervasive. Then we are saying this issue is material and pervasive. Pervasiveness. I think you can look for the wording, but pervasive. So that would mean this issue is material and pervasive, meaning it affects the whole financial statements. So if we disagree on the issue which affects the whole financial statement, actually, in this ground, it can lead to an adverse opinion, as I will explain later. Number two, we are dealing with the issues that affect part of financial statement. The issue affect part of financial statements. Now, okay, the management has responded from the audit query, and now we are at a discussion to finalize our financial statements. Now, what are the reports that we can end up issuing to our client? Actually, now let's put this table so that you better understand them clearly. For example, let me start here. One of the key issues, there is either the fact condition. As I said, number one, you can disagree with an auditor. You can disagree with an auditor, or on response, you lack time. So disagreement with auditor may arise. Disagreement, root number one. Disagreement with management. You can disagree with management, or there might have limitation of scope. You don't have time. Limitation of scope. Now, if you disagree with auditor, now we go to the subject matter. What is the subject matter that makes you to disagree? If the subject matter affects the whole financial statements, so I put something here. If the subject matter affect the whole financial statements, or if the subject matter affect part of financial statement. So there are two cases also on disagreement. The same, if you disagree, if you have limitation of scope on an issue which affect the whole financial statement, or the issue which affect part of financial statement, we have to make it clear. For example, here we are saying now affect whole financial statements. Here we're saying affect part of financial statements. Now let's make it clear here, so that now you understand what I'm saying here. Sorry. Okay. Assume you had a discussion with the management and you disagree with the management for an issue which affects the whole financial statement. That will mean the whole financial statements has been nullified. Therefore, an auditor will issue adverse opinion here. auditor will issue adverse opinion. So if you disagree with a management for the issue which affect the whole financial statement, then a supreme auditor will issue adverse opinion. But if you disagree with an auditor for an issue which affect only part of financial statement, an auditor will issue an except for report. We say an except for report, that the auditor agree with financial statement except for this part. But for this one here, the auditor does not agree with the whole financial statement. Let's see. This is on disagreement with the auditor. Now, number 2, limitation of scope. Let me give you an example on disagreement here. For example, if a municipal council has prepared financial statement and presented a revenue of 800 million during the year, and an auditor has gone through the financial statements and find that out of this 800 million, 75 million shillings represent missing vouchers from the MUSE. So an auditor can't find evidence of where is the 750 million shillings. As you can see from here, almost the auditor agree 50 millions out of 800 millions. Now, if you examine the statement of performance as it works, the statements of performance represent the revenue and expenditure during the year. Now, if almost 750 million, the supporting documents has been created, has been cooked. Actually, in this ground, it is very, very rare that the auditor will agree with the statement of performance. Now, the statement of performance has an impact on the statement of financial position and also the statement of net asset and also the notes to financial statements. So if almost 750 millions have supporting documents which are missing, therefore an auditor is attracted to issue adverse opinion because the auditor does not agree with the whole financial statements. This is our only disagreement. Now, what happens when the auditor does not agree with supporting documents amounting perhaps 500 million? They are missing. Or 10, let's say 10 million. If 10 million shillings represent revenue with missing payment voucher, then from this ground, it is apparently that out of 800 million, 10 million payment vouchers in respect of this revenue are missing. So an auditor may issue an except for report that financial statements are presented fairly except for a revenue representing 10 million. That's how it works. This is how except for work. Now let's see limitation of scope. In this ground, an auditor have got no enough time to handle the evidence. For example, stock taking exercise. If during stock taking exercise, for example, during COVID, an auditor is supposed to go and observe physically the stock taking exercise. Now, if it happened that the auditor did not have time to go and observe for inventory stock taking, for example, because of COVID calamities and other cases. So if it happened, the auditor has a limited time or limited factor, or the auditor has no money to go there and investigate some of the items he wished to investigate in his plan. So this is what is a limitation of scope. For example, it happened that the auditor is requesting an evidence to have inventory technical issues. For example, the mining inventories. Mining inventories, actually, they need some expert to investigate the value. So if the auditor has no time or no money or no way to get this value so that he can rely on evidence, then we're saying the auditor has a limited scope on getting evidence or getting started from particular matter. Now, if that item in discussion affect the whole financial statement, for example, if you are auditing a mining commission where the whole revenue represent inventory to be tested by an expert, in this ground we're saying the item that you don't have a time to work on it affect the whole financial statements. In this regard, an auditor will issue the so-called disclaimer opinion. This is how a disclaimer opinion works, that an auditor has a limited scope on issue which affect the whole financial statement. If the item does not affect the whole statement, therefore, an auditor is attracted to issue an except for report opinion on it. So you can see the way I've made it. So there are two reports which now are technical. We have this adverse report and this adverse report, this adverse opinion, and disclaimer opinion, which are very sensitive on the audit report. So what I'm saying is, when the auditor has seen something, the auditor has observed misstatement in the financial statement, this is how to get started. Now, let's make a summary on this discussion so that you can get started on what I want to make it simple to you. So during sample, the auditor, so sample result. Number one, we are saying the auditor has observed nothing. The auditor has seen no misstatement. That's case number one. Number two, I is saying the auditor has seen misstatement. So there is misstatement, there is no misstatement. Has seen misstatement. So in this ground, we're saying there is no problem here. There is no problem. there is no problem. For example, if you are taking HIV test, if it is not reactive, we are saying HIV non-reactive. No problem. So non-reactive. Here, there is a problem. There is problem. When there is a problem, manake in financial statement, it has been misstated. There is no problem, HIV no non-reactive. There is problem, HIV reactive. Now, what are the cases here? That's where there is a technical jargon saying that when there is no problem, an auditor issue the so-called unqualified opinion. That would mean the reagent has not qualified to see problem. Unqualified opinion. I'll be back from here, meaning that in sampling, the reagent has not qualified to see problem. When there is a problem, we are saying there is qualified opinion. Here, there is qualified opinion, meaning qualified opinion here, meaning the reagent has observed some misstatement. Qualified opinion. So types of opinion, we have qualified, so we have unqualified opinion and qualified opinion. Unqualified and qualified. Now, in this qualified opinion, there are 3 classes. If we have seen the problem, now we have to observe the magnitude of this problem, classified as number 1, adverse. So it is qualified. What was the nature of qualification? It is adverse, meaning the management has disagreed. The auditor is in disagreement with the management for an issue which affects the whole financial statements. Number 2, disclaimer. Opinion. And number 3, except for opinion. And some people will now to be able to list types of qualification as follows. Number 1 is said unqualified opinion. Unqualified opinion. Number 2 could say adverse opinion. Number 3, we could say disclaimer opinion. Number 4, we could say except for opinion. That is how it works. So I would like to summarize in this way. You can put them also in Swahili so that you can understand it more clearly. So these are types of audit opinion. Now this unqualified opinion, it is notably known clean opinion. Clean opinion because the auditor has observed no problem. Clean opinion. Clean opinion. And this one here is dirty opinion. Notably known dirty opinion. Dirty opinion. But the way it is dirty, it depends on which item are you discussing. Now let's see. our problem was to explain what is a fair presentation. Now, if financial statement has been presented fairly, meaning no error, no misstatement, the auditor will issue a clean opinion. So that's why people are celebrating here. If we go to test for HIV and the doctor is saying it is HIV non-reactive, meaning that in your blood, nothing wrong. It is clean. But if he is not telling you straight that please wait a bit, I want to go further test, meaning that the auditor has seen some of the issues here there, and he can't say direct that it is clean. Therefore, it is dirty. Now, we are required to explain this paragraph that in my opinion, the financial state presented fairly in all material respect, the financial state position or Ministry of Transport at the third use of financial statements in cash for whatever. Now, we have to explain why is this opinion issued there so far. From the answer. Now, the term fair presented, and because we have applied Ipsas, we have to go to Ipsas number 1 and see what is the requirement of presentation of financial statements in Ipsas compliance. Once we go to Ipsas number 1, paragraph number 27, it says that this is the requirement in Ipsas Tanzania, that fair presentation and compliance with the Ipsas mean the following. Number 1, he said, financial statement shall present fairly the position, the financial performance, the cash flow of an entity. So you must present fairly the balance sheet, the net asset, the cash flow, and the others. Now, fair presentation requires the first presentation of the aspect of transaction, other events, condition in accordance with definition and recognition criteria for asset, liability, revenue, expenses set out in Ipsas. The application of Ipsas with the conditional disclosure when necessary is presumed to result into financial statement that achieve fair presentation. Now here it is technical. For example, if you have presented a statement of balance sheet and you have not conducted impairment review, you have not conducted review of useful life, your PP schedule are not in accordance with secular and treasurer, then it's not possible that you have a fair statement of financial position. If revenue are missing in statement of performance, then that is not a faithful presented. If the cash flow does not balance, then this is not a fair presentation. And that's why an auditor will have to investigate, examine the notes and other key issue that represent recognition criteria of asset, liability, revenue, expenses, and other criteria. So this is how it works. So when I say this statement are presented fairly, that means it is in accordance with the Ipsas number 1, paragraph number 27. Now, if you go further in paragraph number 28, the entity whose financial statements comply with the Ipsas shall make an explicit and unreserved statement of such compliance in the notes. If you have adopted Ipsas so far, for example, as from local governments in 2018-19, all LGA adopted Ipsas. Therefore, in its financial statements, the LGA must present it in the notes that they have adopted Ipsas. Now, if you have adopted Ipsas in your financial statement, but contrary to your statement, you are using issues which conflict the Ipsas, then you are not fair represented. Number one. Number two, if it requires that your entity to present using Ipsas, but you have presented the financial statement using FRIs or cash basis, then from there, your financial statements are not fair presented. This is how we can review on a fair presentation. So it says that financial statements shall not be described as complying with Ipsas unless they comply with all the requirements in Ipsas. So if you have adopted Ipsas, you have to comply with the old standard in Ipsas, not only part of the standard. So if you apply part of standards, then that is modified Ipsas accrual, not full Ipsas accrual. Let's see further on paragraph number 28 of Ipsas number 1. It says that in vitro, it says in vitro, all circumstances, a fair presentation is achieved by compliance with the applicable Ipsas. A fair presentation also requires an entity number 1 to do what? To select and apply accounting policy, accounting estimates, and errors. If you have complied with Ipsas, but accounting policy, accounting estimate have not been tabled as per requirement, then it is compromising to say that you have complied with fair presentation. So fair presentation also may represent the way you have presented your accounting policy, your accounting estimate, and the collection of errors. Remember, 3 issues. We have accounting estimates, we have accounting policies, and we have to account for errors. For example, if you discover worst workers in the reporting period, and it comes into your mind that these worst workers arises from 3 years ago, then in a current financial statements, you have to correct these errors retrospectively from the date when they arises. This is collection of errors. Now, if there are errors in a prior period and you have not collected them, it is not easy to say that you have complied with the fair presentation. For example, in most public sector in Tanzania, most of the PP schedule have gone to 0 while still in use. Government entities and ministries have financial statements in which the motor vehicles are fully depreciated but still in use. These incidents represent accounting error where the ministry did not revise the useful life as per Ipsas number 17. Therefore, it is required that the ministry should revise them accordingly in Ipsas number 3, collecting it respectively from the date when this revision was not done. So if there is fully depreciated asset in your financial statements, then actually your financial statements are not fairly presented. So as Part B said, to present information including accounting policy in a manner that provides relevant, faithful, representative, understandable, timely, comparable, and verifiable information. Number C, he said that to provide additional disclosure when you comply with the specific requirement in Ipsas is sufficient to enable the user understand the impact of particular transaction on other events and the condition of the entity's financial position and financial performance. So in summary, what I could say now, what is a fair presentation? Number 1, you could say a fair presentation in summary now, so that you get marks. First, presentation of the effect of transaction or other events, the condition in accordance with definition of asset, liability, and revenue. You have to select and apply appropriate accounting policy so that you comply with fairly. So fairly means 1, complying with Ipsas, 2, selecting appropriate policies. We have this recognition of asset liability in a manner presenting information including accounting estimate in a manner provided by relevant liability. You have to present your accounting policy in financial statement in the notes. Number 4, you have to provide additional disclosure on compliance with specific requirement in Ipsas. Because, for example, if you have applied the revenue from non-exchange transaction and those stipulations are conditional, then you have to describe that revenue Ipsas number 23, we adapted this. I mean, there is a conditional stipulation. You disclose them. For example, another example, if you have applied Ipsas, I mean, in PP schedule, if you have elected to use cost model rather than the valuation model, then you have to present that Ipsas 17, we have applied the cost model. In agriculture, you have to represent the way you have presented your animals and plant. You can use either fair value model or cost model. So whatever the model have been selected, then you have to disclose in Ipsas 27. Also in borrowing cost, there are also alternative and benchmark, capitalizing or expensing. This is to do with how to respond from this what is a fair representation. I've decided to describe in detail this answer so that when it happens sometimes, you are able to grasp the knowledge and feel comfortable. Not only to respond to the problem, but also to have other knowledge which may happen during your examination or during preparation of financial statements. So this is how fair representation means in audit, and even on how you can respond from this problem, or even to understand the way you should answer. So you should not follow what I've been talking here, but this is the knowledge for you to make and get acquainted to these 4 points as I've described here under. So remember these 4 points. Fair presentation. It has 4 criteria. 1, recognition of asset. Number 2, selecting accounting policy. Number 3, presenting particular policy. Number 4, complying to Ipsas. Supporting discussion. These are supporting discussion that you can refer even in other time. So let's go to another question. Question number 4 in the same paper. Question number 4 in the same paper. Question number 4 in the same paper. It says that the mayor of Tangamano Municipal Council, who attended one of the NBA seminar, has urged against preparation of Ipsas financial statement for its municipal council in favor of FRS. He has maintained that FRS has not more standards, has a lot of standards in issue, almost 41 international accounting standards, including those which have been withdrawn, 16 FRS plus 6 F whatever. Required, write a brief note to the mayor why the municipal should prepare financial statement using Ipsas. Now here, technically, should be very much aware. Who is a mayor? Actually, the mayor is a key management personnel within a municipal council. We have the mayor and this council. We have the treasurer accountant. Now, why should we apply Ipsas in the municipal council? That is the basic problem. Why should we apply Ipsas in the municipal council? Why should we adapt Ipsas to NGO? Why should we adapt Ipsas to some government agents? Because of these reasons, you have to refer from directive issued by NBA, who are the user of Ipsas so far. At this point, who are the user of Ipsas and why? From technical pronouncement number 1 of 2018, issued by NBA, it describes clearly who are the user of Ipsas and who are the user of FRS. and who are the user of micro entity, who are the user of any of the standard. Now, for the case of Ipsas, there are two criteria, number 1 and number 2. So, number 2, it says that all political parties should apply Ipsas. This is the directive. All political parties should apply Ipsas. For example, CCM, Chadema, CAF, and all registered political parties. It is now mandatory in the pronouncement number 1 of 2018 to apply Ipsas. So it may arise a question that you have been given a political party registered through the rules in Tanzania, and somebody requests you, should they apply Ipsas and for which reasons? Remember, this is how it works. Now, for other public sector in Tanzania, he said all public sector entity with the following characteristics must apply Ipsas. Number 1, if a public sector is responsible for delivery of service to benefit the public or to retribute income and wealth. If you are there to deliver the services to benefit the public, then that is case number 1. For example, the national insurance in the country for the government, it is responsible to deliver the service for the benefit of the country. Therefore, NHIF will stay here. PSSF, it delivers the service for the benefit of the country. Therefore, this condition number 1 is there to stay for PSSSF. TANESCO, to render electrical services. DUWASA, to render water services. So they have to go for this, number 1. Number 2, it says, a public sector mainly financed the activities directly or indirectly by means of taxes, transfer from other level of government, social contribution, debts or fee. For example, you have to observe from NHIF, where are the source of funds from NHIF? Are they coming from the government? Is it a contribution from members? Is it a transfer? Also, is it a tax? So as you see from NHIF, main source of revenue is from the government. Therefore, NHIF have to comply with Ipsas in condition number 2. The same PSSF. The huge funds are coming from social contribution, lesser from investment in its sources of assets. Therefore, PSSF in this ground have to go for Ipsas. Number 3, condition number 3, do not have a primary objective to make profit. So as you see, most of the public sector in Tanzania have been established for service delivery only. Although, so I can classify some exception here. For example, we have TCL, we have ATCL, you have BOT. Let me discuss a bit this one here. So you see TCL, they are not financed by this. You see, much of it is revenue from exchange. Therefore, TCL have gone to FRS. The same to ATCL. ATCL, the major funds is from fare, transport, and other cases. It is exchange transaction. The same to BOT. They sell bonds at market value. Therefore, BOT also, they will use FRS less than Ipsas. So this is how you can advise the mayor that you have to consider the three conditions. Although the details explanation must be supported to make the mayor understand. So this is how you can apply this technical pronouncement to cater the problem. But also, it has get another technical pronouncement requiring all NGO to use Ipsas in Tanzania. This is now a mandatory. You can be given another question requesting you to assess whether an NGO should apply Ipsas or not. So this is a technical pronouncement that requires all NGO to apply what? Ipsas in capacity so that they comply with this technical pronouncement, and this has been a mandatory from 1st July 2021. So, as you can see this paragraph here, let me read. The Organization Act 2002 and Society Act Cape 337 have gone through major amendments under written laws, Miscellanea number 3 of 2018 regarding registration and operation of the entity. The amendment overall requires a higher degree of adherence to principle of financial transparency, good governance, and accountability in the provision of the public service. In light of the above, and the need for NGO and association to have a common financial reporting framework, NBA now directed that on a meeting held on 20th June 2020, approved the applicability of Ipsas by NGO and association in Tanzania. Therefore, all NGO and association will be required to use Ipsas in their financial statements. So actually, what I'm doing here is to make life easier so that you don't have problems. So NGOs are supposed to use Ipsas. And from this evidence, if you've been given a question relating to NGO, please remember to comment that NGO are supposed to use Ipsas. So this is question number 4 of 2016, representing some part of introduction. And I'm sure when you listen from it, you'll feel happy. Let's see open paper. Paper 2, which was held on 15 July 2016. What was the part of issue to make it more easy for us to feel happy? Actually, he has started as follows. This is paper 2, question number 4A. Due to complexity of international public sector accounting standard Ipsas, often judgment used at the time of transaction to Ipsas have resulted into prior period adjustment and change in estimate being disclosed in financial statement. The selection of accounting policy and estimate techniques is intended to aid the comparability, consistent financial statements. However, Ipsas also place particular emphasis on the need to take into account qualitative characteristics and the use of professional judgment when preparing the financial statements. Although Ipsas may appear prescriptive, the achievement of oral objective for set financial statement will rely on skills of the preparer. Entity should follow the requirement of Ipsas number 3. Accounting policy, changing accounting estimate errors in selecting this one. However, the application of Ipsas number 3 is often depends upon the application material analysis to identify issue relating to guiding a report. Required. Always, actually, you should study with required. With examples, indicate how accounting policy, estimate, collection of errors, or period errors can be used to achieve management targets with regards to financial reports. Actually, this question is with Ipsas number 3. with examples. Now, let me go through this one here. And then we can see how to handle this problem. With examples. Now, Ipsas number 3. Prescribe 2 issues. Number 1, accounting estimate. Number 2, accounting errors. So accounting policy. And number 3, prior period errors. Prior period errors. Now, we should go for definition. What is an accounting estimate so far? Accounting estimate actually, in order to describe accounting estimate, accounting estimate are those procedures which results into a carrying amount of asset or liability. So account estimate, we are talking about procedure that results into a carrying amount of asset or liability. Now, what are these procedures so far? For example, examples of accounting estimate. So remember, the aim of accounting estimate is to estimate the carrying amount of asset or liability. So, how would we get started to get examples? From this example, number 1, example number 1, selection of useful life. Useful life. If you select useful life, it's now possible to estimate depreciation and get the carrying amount of asset. So, selection of rate of depreciation. If you select the rate of depreciation, you could get a depreciation amount which results into a carrying amount of an asset. Number 3, selection of method of depreciation. If you select the method of depreciation, possibly you can read into having an appropriate measure of how to get the carrying amount of a non-current asset. Bad debts. Now here, estimation of bad debts. You see, it's very clear. Estimating the bad debts, it's possible you can now get the carrying amount of receivable. It's possible to get the carrying amount of receivable. So, selecting the bad debts is possible. You can get the carrying amount of receivable. Let's put it here. Estimating bad debts. Number 4, estimating the provision. Estimating the provision for liability. Then possible you can get a liability from it. Number 6, we have estimating the amount of impairment of asset. We have inventory obsolete. Inventory written down values. We have estimation of fair value of an asset. Estimation of fair value of asset. So these are the key issues you can see. So reaching estimate, that's how to work. So accounting estimates as to X, I'll explain the summary on how to apply them, but they are applied prospectively from the date of application. Now, accounting policy. Accounting policy. What are the accounting policy? These are judgment, conversion, assumption. See, tiers. These are judgment, procedure, assumption that the entity apply when preparing financial statements. So these are judgment, conversion, rules, procedure that an entity will use when preparing financial statements. Now, examples. Actually, in order to understand the difference between accounting policy and accounting estimate, we should be very much aware. Accounting policy affect the following key issues. Accounting policy affect the following key issues. Number 1, accounting policy affect presentation. Accounting policy affect measurement. Accounting policy affect recognition. Accounting policy affect disclosure. We have presentation, disclosure, or definition. Definition, and also it affects disclosure. I will explain examples and others. Let's see examples of accounting policy. It has been a debate as to whether this is accounting policy or this is an accounting estimate. So in order to make it understandable, you should get started from there. Now, what are the examples of accounting? Examples now. Examples of accounting policy. It can be described that accounting policy have gone through their standard. For example, changing from accrual to cash basis. Changing from cash basis, to where? Accrual basis is a change in accounting policy, a noticement, and this is applicable in Ipsas number 1. So once you change from cash basis to accrual, then you affect recognition of asset and liability. What is affected here? Recognition of item, asset, recognition of revenue, and expense is affected. Therefore, item number 2 is affected. So it does not affect the carrying amount, but it affects recognition of asset and liability. If you are moving from cash basis to accrual basis, and this is applicable in Ipsas number 1. Example number 2, changing from either FIFO to AVICO, average cost method. AVICO. Here, this is in Ipsas number 12, inventory. What is happening here? You are changing measurement basis. There is an effect in the measurement basis. Measurement basis has been described in item number 2 here. Measurement basis. Now, number 3. I'll just give you example of accounting policy. Capitalizing or expensing borrowing cost in Ipsas number 5. You can either capitalize it or expense borrowing cost in Ipsas number 5. This is also a change in accounting policy because it affects this, affect definition, and recognition, and even presentation. For example, if you capitalize borrowing cost, you have to present it in the balance sheet as part of an asset. And saying it is an asset, then you are defining an asset. If you expense similar items of borrowing cost, then you have to present it in a statement of performance. So you are changing presentation and you are defining expense as a liability and not an asset. So this is an accounting policy because there is a change in definition, recognition, presentation, and even the way you can disclose in financial statements. So, example number 4. Example number 4. Example number 4 we have revaluation model. So somebody is changing revaluation model to cost model, changing from cost model to revaluation model in Ipsas number 17. So if you've been using cost model and you want to change this to revaluation model, this is a change in accounting policy available in Ipsas number 17, because you are going to change the way a measurement of asset is done. You are changing the measurement, the way in which an asset is done. The same, number 5, research accounting for research and development in Ipsas 31. Intangible asset. There are 2 treatments here. Number 1, you capitalize or you expense, depending on 7 factors available in Ipsas number 31. So from there, you can see a lot of issues to be tabled with accounting policy. I've given you some examples of accounting policy so that you get started. Now let's see prior period errors. Prior period errors. What are the prior period errors? Prior period errors. Prior period errors. These are the error which arises. So we're saying these are the errors which has been detected in the current year, but in actual sense they have been detected in the current year, but they have been arising. They have been arising in a prior period. Prior periods, the previous audited financial statements. Previous audited financial statements. So these are prior period errors. That is how we can see them. Examples. What are these examples of prior period errors and how to account for them? Examples. Examples of period errors. Number 1. Example number 1. Discovery of ghost workers in prior periods. Discovery of ghost workers. So if today you discover that you have 10 ghost workers in your financial statements, which has been appearing in 5 reporting periods, then that is a prior period error. Number 2, application of accounting policy. You have been applying accounting policy for 2 years in a wrong way. That is, you have detected this year. Number 3, existence fully depreciated asset while still in use. You have computation of depreciation amount. You have been depreciating non-current asset in a wrong way from past 10 years. Failure to recognize asset and liability in a financial statement. You have some asset which has been in existence and you have been using them for the minutes, almost 10 years, but they never appear in a financial statement. So you have asset, but not in a financial statement. These are what you call off-balance sheet items, which is a problem. So once you detect this kind of error, they have to get being collected according to Ipsas number 3. Now that's why now it comes. How do we collect these errors in financial statements? How do we account for? Accounting estimate. How do we account for accounting errors? Any others? Now let's draw this line here. Let's say this is a current period. Current period under review. And this is previous period. So we have, for example, year 2019. This is year 2020. And this is year 2021. And currently, we are in this year. This is currently. And forward looking, we are going to 2023 and 2024. So, previous period. Now, when I say retrospective, going back, retrospective going back. When I say prospective going forward, prospective. Now, if we want to collect for prior period error, you should go retrospectively. So prior period applies prior period, apply retrospectively to the date where the error arises. If you want to correct the accounting policy, you should go 1 year retrospectively. So accounting policy must be applied retrospectively 1 year. But accounting prior period errors, you move retrospectively to the date when the error is made. Now, for the accounting estimate, you should apply them. Accounting estimate, you should apply them prospectively. So this is my suggestion on how, when you draw this one, possibly you can understand. So once you detect them in a current period, how to apply this. So once you draw this one, you explain now what is prospective application, what is the retrospective application, how do we account for errors, how do you account for accounting policy, and how do you account for accounting estimate. Now it comes to reasons. What are the conditions so that an entity can change accounting estimate, policy, and other criteria? Why should we change them? You can change them. Actually, in principle, Ipsas number 3 says once adopted, accounting policy and estimate must be applied consistent within several years to come. But there are some conditions which may cause a public sector to change. One of the conditions is, number one, if the accounting policy exists in a particular standard. For example, inventory, Ipsas number 12 has two models of a policy, which is FIFO and AVICO. Now, if that Ipsas number 12 has been revised and one of the policy has been deleted, from that ground, you can change to accompany changes in standards. The same, in Ipsas number 5, borrowing cost, we have two, benchmark and the alternative. So capitalizing or expensing. If Ipsas number 5 has been amended to remove those policy, then you have to comply with Ipsas to change that policy whenever it exists. So that is item number 1. When the standard has changed, then we can be enforced to change the policy so that you comply with the standard. Now, reason number 2, if the management itself, who is responsible for changing these policies, has held a meeting using a professional expert in a particular policy, and it finds that it is more presentable, faithful, and relevant to change the standards, then they can change. So there are only two conditions. For example, in Tanzania, we have been applying indirect method in cash flow for several years. But it happened that the management decided to change from indirect method to direct method because they said that it was more presentable to public sector in Tanzania. Therefore, the management of Tanzania have changed it, not because of standard, but because the management, it found it's more presentable, more relevant, and faithful to present using direct method rather than indirect method in public sector Tanzania. So now it is a mandatory, and the circulars has been issued so that you present the statement of reconciliation of the cash flow statements in financial statements so that you comply with the changes in accounting policy. So those are my observations, and I'm sure leading my observation together with what has been the answer here, it is now possible for you to pass the exam. Actually, let me put these reasons here. So far, reasons for changing accounting policy. Reasons for changing accounting policy. Number 1, when Ipsas has been amended to replace the policy. When Ipsas has been amended to replace the policy, or when new Ipsas. When new Ipsas has been issued to add another more presentable policy. Number 3 is when the management held a meeting to see that it is more relevant and faithful to change the policy. Then with these 3 reasons, possibly you are advised to change the policy. So let's meet the last question here for today's discussion, so that you can cope to other key issues. As an expert, I'd like to recommend you listen carefully and strategically. What he's saying here, you are the head of finance of the government agents under the Ministry of Finance. Your budget is financed from the main government budget at 80%. Currently, you are in the process of preparing financial statement for the year ending 30 June 16. You want to make analysis of going concern issues. Now, the problem is going concern issues. What is a going concern issues? Your chief executive officer, who is not a professional accountant, has informed you that the going concern concept is less relevant. Now required, analyze issue which you will consider when assessing going concern. What's a going concern? Actually, all these issues are in Ipsas number 1. Going concern, Ipsas accrual, and all other cases. Now, in order to see the going concern issues, because you have to present financial statements based on going concern issues. So, in summary, the management uses the going concern issue assumption management use of going concern issue is also relevant to public sector entity. For example, international public sector entity number 1 addresses key issue of going concern issues. For example, we have different contingents. We have different cases that may arise to going concern issues. The determination of whether the going concern issues assumption is appropriate is primarily relevant for individual entity rather than a government as a whole. So a going concern issues always direct to a reporting entity, not to the government as a whole. For individual entity, in assessing whether the going concern issue is appropriate, those responsible for preparation of financial statements who are responsible management. For example, in the municipal council, we have the mayor, directors, the district directors, and others. There are ranges of issues. For number 1, current and expected performance. So you have to assess your current and expected performance of an entity. For example, ATCL. ATCL, its current expectation performance, current and expectation performance in 10 years ago was not good. Therefore, going concern of ATCL as a government entity was unquestionable because of current performance. So you have to observe the current performance of entity. So you observe the current performance of TANESCO. Is it a good sound? Are they performing well? That is number one. Number B, you have to assess potential announcement restructuring organization of units. What is this ground so far? This is not now for the public sector. Say, for example, if the president announced that Dar es Salaam city will not in existence, that announcement actually impair the going concern. If the president announced to seize Dar city, then this announcement actually affect the going concern of Dar city. If the president announced that Kadiko will close as on June, therefore, such announcement from the head of state has impact on the going concern. Therefore, if you are preparing financial statements, you have to observe such announcement so that you can see either the organization or seizing the public sector, whatever the way it works. For example, in 2018, the government announced that 4 pension funds in Tanzania have to merge. So LPF, GEPF, PSPF, and others have to get merged. Therefore, the respective accounting officer with such announcement actually affect the going concern in Ipsas number 1. Number C, you have to estimate revenue or likelihood to continue government funding. For example, if the government has passed a law in a National Assembly requiring that it have to stop funding TANESCO. Now, you have to think, is a going concern on TANESCO probable? Because if you stop funding TANESCO, can TANESCO connect its own revenue and stay on its own? Therefore, you estimate the likelihood that the government may announce stop funding. Or if the major donor, for example, TACAIDS, the main funds of TACAIDS is from external donor. If there is a crisis with Ukraine, if there is a crisis because of COVID, if there is a crisis internationally, the head of state is quarreling with these donors, and these donors has shown intention to stop funding, then such kind of announcement may impair the going concern of a public sector which depend 100% from donor. We have potential sources of replacement of financing before it is appropriate to conclude that the going concern assumption is appropriate. So potential sources of funds. For example, if you transfer a huge revenue from TANAPA to Central Treasurer, a huge revenue has been transferred because of past laws from TANAPA, instead of recognizing TANAPA, now to central government. Then the going concern of TANAPA have to be assessed at whether they can now sustain. Number E, whether the government support may be deducted or withdrawn, or in case of privatization. This is also one of the issues when the policy decision are made to affect the service provided in the public sector. For example, when the policy changes, for example, if you transfer parking fee from Talula to LGAs, actually, and if the parking fee was the main source of fund from Talula, therefore, actually, such policy may affect the going concern. Now, when it go for Ipsas number 1, in particular, you can see paragraph 38 explain this one on how it may be assessed in other cases. Also, we have Ipsas 39, we have Ipsas number 40. All these considerations are the key issue to discuss when assessing the going concern of the entity. Therefore, in summary, paragraph 41 is very important when assessing the going concern of an entity. And my request is you to read such kind of summary that I'm presenting here so that you don't panic during examination. And I've done these small questions here so that you can now see the impact on how you can benefit from this discussion. So we have spent almost 2 hours on this discussion. My suggestion is that you keep cool and please don't hesitate the exam. Stay with people with a positive attitude and stay away with people with negative attitudes because of personal attraction, and believe on God. Jesus, the Lord Savior, will help you, and thank you for listening.